Good evening, Marshall Reddick investors, and welcome to this evening's presentation where I, Kristen Tabar, fund consultant and Marshall Reddick real estate advisor and realtor, will be joined by none other but Mr. Patrick Prunty himself so that we can do our Q2 update for the Marshall Reddick Mortgage Fund. I want to thank you all for joining us tonight, and I want to do a quick sound check, make sure everybody can hear us. We're going to be going over a lot of really great info and details tonight with regard to the fund, and we want to make sure everyone can hear. So in your little chat bar, please let us know, yes, we can hear you, no, we can't hear you, and we will try to make some adjustments. Make sure your speakers are on. And we'll get started as soon as we know that our sound check is successful. All right, everyone, as a special treat, since Patrick and I are OGs here at Marshall Reddick, woohoo! We wanted to say hello, let you know we're real people and you are not being spoken to by a droid or a robot tonight.
Yeah, hey everybody, thanks as always for joining. It's always a pleasure to be, a part of Marshall Reddick and to be here with you all who are as I always like to say, the best part of Marshall Reddick. And it's my pleasure tonight to be here with Kristen. Like she said, we're some of the original gangsters at Marshall Reddick. I don't know how long it's been. It's got to be coming up on 10 years.
We have a cumulative 28 years of Marshall Reddick experience between us. So you're in good hands tonight, folks.
Yeah, so thanks again for joining. We're going to get started.
All right, enough goofy camera time. Just kidding. So again, thank you for joining us, and we're going to jump right into it. We want to keep you guys for an hour or less so you can get to dinner or that glass of wine on the couch or whatever you have planned for after this presentation wraps up. As I mentioned, my name's Kristen Tabar. I am a fund consultant here at Marshall Reddick, also a California realtor and an advisor. I've been with the company for 8 years, and I'm really excited to be on this webinar tonight to share about the Marshall Reddick Mortgage Fund, because my husband, Jason, and I have not only invested in the fund, but we've also borrowed from the fund. And we've been able to utilize the mortgage fund, the private lending department here at Marshall Reddick for the last several years. And so I'm really excited to be a part of it and be able to speak to all of you tonight with regard to what the fund does and how it can be a really great investment tool for everyone. So we're going to get started with a poll question here, but first, what is the Marshall Reddick Mortgage Fund? We have a lot of existing capital partners on tonight's presentation. We have some folks joining us tonight who are contemplating getting into being a capital partner, and some who are just here to learn, who aren't really sure what the mortgage fund is and would like to get some more information. So what is the Marshall Reddick Mortgage Fund?
Absolutely, and appreciate the crowd participation. We're running the poll now. We'll give us a few minutes, but this is to get everybody kind of participating, right? And we have, although like Kristen said, we've got a lot of existing capital partners, people that have positions in the fund, but we also have quite a bit of new people who maybe don't know anything about what the mortgage fund is or about our private lending department. Or we have some people that have been in consultation with our consultants like Kristen, like Vince Tomich, like Tyler Degler, and so on. So this is, again, just to get the crowd involved. And so we'll just give it another 15 seconds or so, and certainly appreciate you guys participating. All right, just another minute. We'll go ahead and close the poll. Okay, and I'm going to publish the results. So looks like most folks are on top of it, right? So indeed, it is all of these things, right? The mortgage fund is a Regulation D 506C private placement. That's kind of a fancy term there, but definitely it is a first lien only debt fund managed by Marshall Reddick and our rather large team these days. It is also a pool of accredited investors who enjoy a consistent income. We'll talk a lot about that. And it's definitely a truly low risk, well-diversified means to earn 8%. So those of you who selected all the above, you are rock stars. All right, thank you.
Thanks, everyone. All right, and for those of you who would like a little bit more information, a little bit more detail, or you want to learn more about the fund in general, this first handout that we've attached for you is titled, What is the Marshall Reddick Mortgage Fund? And this handout is going to be your easiest, fastest, most comprehensive way to get more details about the fund and get a little bit more knowledge under your belt so that you're prepared to have that consultation or speak with a fund consultant if you'd like to learn more about getting yourself involved.
Yeah, it's just a short article. It's 5 to 10 minute read. It really, if you take the time to read that and you're interested in understanding exactly what it is and how it operates and so on, that's the easiest and fastest way, as you mentioned.
So we're going to cover quite a bit today. What is it that you're hoping to learn today? A lot of folks ask, how long has Marshall Reddick been in the private lending space? Well, we introduced our private lending department in 2010, and really we introduced it as a means to help our clients to continue to purchase real estate in the economic climate that was present in 2010. As an extension of that, as a real estate brokerage, when people are not buying real estate, you have to find ways to shift and pivot to create streams of income for your business as well. So private lending gave Marshall Reddick Real Estate an opportunity to help our clients continue to invest while also keeping a stream of income for the company as we were lending out money to borrowers who were not able to qualify or using other means outside of conventional products to finance rental property.
Yeah, I mean, absolutely. I think that we didn't think in 2010 that it was going to turn into the department that it has today, but it really complements our brokerage business and our property management business. And the brokerage and property management business complement the lending department. And as Kristen mentioned, lots of our Marshall Reddick clients participate on both ends. And Kristen is a prime example of that, right? She has done a lot of the direct lending that we're not speaking about tonight, where she was actually one of the note holders. And she also, of course, now her and her husband have a position in the mortgage fund. That's one of the requirements of being a fund consultant here. But also, Kristen and Jason, they borrow from us regularly in our private lending division for their real estate needs. So they focus heavily in Cape Coral, Florida, a lot of new construction. And a big part of our private lending division, including the mortgage fund, is ground up new construction. So thanks for being a client on both ends.
Thank you, Pat. Thanks for providing the service I need. So the Marshall Reddick Mortgage Fund was then introduced just 3 years ago in 2020. As Patrick said, a means for our investors now who want to continue to invest in mortgages and in trust deeds, but this offers a truly passive, low risk means of investing in these notes. All right, we get this question a lot, and the answer to this question is actually constantly changing, which we will dive into later on in the presentation. But as of July 1, 2023, we had approximately 49 million in the fund that is currently being lent out. So as I mentioned, that does continue to grow and it continues to build, and we'll dive into some of those specific numbers as we continue. And since March 10th of 2020, when the fund was started, we paid 8.65% annually. So as we mentioned, the consistency is there. It's a truly passive, consistent way to get that 2% quarterly return. So what's tonight's agenda? We are going to be talking about fund basics and details. We're going to cover some info. We're going to show you what the portal looks like, how you can get to that portal, and most importantly, the rundown on Q2. For all of those who are currently invested, And for those of you who are interested in investing and want a little bit more information tonight, this is where all the meat and potatoes of tonight's presentation really are going to be.
Yeah, and if we haven't mentioned it already, we certainly would love to address questions from the crowd. When we get to the end, we're going to be having just some standard questions that we field day in and day out. And depending on time, we'd love to address the questions that you might have that are joining us tonight. So feel free to ask those questions in the chat bar, and we'll address them as time allows.
All right, fund basics. We're going to hop right into some of the basic information as it applies to the Marshall Reddick Mortgage Fund. So there is a $25,000 minimum investment, and that is a 12-month minimum hold. What does that mean? It means you can invest $25,000, $50,000, $100,000, and we're going to hold that for 12 months, at which time you can decide, take it out, keep it rolling. But that 25, 50, whatever your initial investment is, that is going to be a 12-month minimum hold in the fund.
Yeah, and we structured it this way on purpose, right? It's a low threshold of investment. Obviously, this is something new to Marshall Reddick, and folks really like it, right? But we wanted them to be able to build exposure to our fund over time, and also not to have a big, long lockup period. A lot of syndications that are out there, you know, they're asset syndications and not debt syndications. We're a debt fund, and so we wanted to really make this a very liquid investment. And we're very confident in our business model. I think we've proven that over the first 4 years of operation. And that way, you know, you can add and take capital as suits your needs, right?
Yep, and as Patrick was just saying, it's a low threshold, and the dividends can be paid quarterly, your distribution. So if you put in that $100,000 investment off the bat and you'd like to take your quarterly distributions, you can take them, or you can reinvest. Actually, about 75% of our capital partners do reinvest their quarterly earnings to continue to earn on that throughout the year. So you do have that option. You can also add more, as Patrick mentioned. You can add as desired, and each new contribution will then just carry its own 12-month minimum hold, also subject to reinvestment or quarterly distributions at your selection.
Yeah, I think it's important to note there, a lot of times we get folks asking, like, does each contribution, additional contribution, need to be in increments of 25,000? And know that the minimum additional investment or contribution would only be 1,000. And we have a lot of folks that are starting to get on what I call like a monthly or a quarterly drip, where they say, hey, you know, like, good, let's start with 25 and then let me put in 1,000 a month, or let me put in 5,000 a quarter, or whatever they desire. We can accommodate those things.
Absolutely. And you can redeem your capital as desired, partial or full. You can reinvest, and that makes it really, really easy to get into the fund and start earning and start feeling the rewards of your investment. A couple more fun details for you. We covered this on our first poll question. Some of you were paying attention. We are a California partnership, and you will receive a K-1 annually as a partner in the Marshall Reddick Fund. As with any investment, of course, we definitely recommend you talk with your tax professional to get any advice prior to investing. We here at Marshall Reddick are not tax professionals. We cannot give tax advice. We can only give you the advice related to the fund and what we know about it, and give you all the info that you need from our end before making that investment. You can also invest with a self-directed IRA. 65% of our capital partners are represented by self-directed IRA investments. So it's a great means of investing with your retirement account because you're not going to be subject to UBTI. Yay! And reinvestment here is the key. Once you invest with that self-directed IRA, you can select the reinvest option and continue to have that money grow for you while it's invested in the fund.
Yeah, just one small correction there. The 65 is actually the number of partners that are investing in the fund using a self-directed retirement account. Could be a self-directed IRA, could be a solo 401k. There's many variations there, but that's actually a 65 count. That works out to roughly 25% of the roughly 250 plus capital partners that we have today.
Thank you, Patrick, for the correction. And finally, to invest, you must qualify as an accredited investor. We will get to what that means and how you can show us that you are accredited as we get farther into the presentation. So let's launch our second poll question.
All right, let me get that going.
We'd mentioned there's lots of different folks on tonight's presentation, so I'll let Patrick take away our next question.
Yeah, just I've got it published on the screen for you, and just kind of wanted to show, all of those that are on the call tonight. Like, what is the mix of the folks that are on? Is it, a lot are investors, a lot are, those that have been talking to us for a while and just haven't made the advancement yet to take the leap, if you will, or those that, hey, I don't have a clue, but call me and let's have a discussion so that I can understand whether this is actually something that's right for me. Because certainly there's pros and cons to every investment, and the fund carries its pros and cons. It's much different than owning real estate. It's much different than an asset-based syndication. But I will say that I think there's a very good argument for a 10 to 15% of one's liquid net worth to invest in a very stable income producing fund like ours. So everyone's got to make that own decision on their end. And again, thanks very much for the participation. I'm going to go ahead and close that poll and we will publish the results. Okay, so now you've got the results on the screen. So of the attendees, 69% are already investors. Yay!
All right.
I agree. I am one of those, right? Kristen is one of those. We both have a significant position of our own individual capital in the fund, and we totally agree. It rules. And then we also have an even mix of like the other, 30%. Some ready to go, some not quite sure, but love learning and love the online events or in-person events that Marshall Reddick does from an educational standpoint to help folks decide what they'd like to do. So let's get that hidden now and we can move forward. Thank you.
Thank you everyone for participating. You've already been hearing from him tonight. Patrick Prunty is going to jump in and give some additional fun details. As we mentioned earlier on, Patrick's been with Marshall Reddick for 20 years now. He is our private lending director. Lots of my clients, when they need money help, they're looking for financing, they still go to Patrick. He is synonymous with lending when it comes to Marshall Reddick Real Estate. So it's a pleasure, again, to be on this presentation with him tonight, and we're going to let him cover the next couple of slides. Patrick, take it away.
Yeah, thanks. Really enjoy what I do every single day, and so it's made this less of work and more of fun. And it's really been awesome over the years to have an impact on people's financial lives, to build relationships with people, and also to have the exposure to the investment opportunities that I have. So I love what I do. I built the private lending division here from the ground up, starting back in 2010, and the mortgage fund is just the evolution. We certainly are going to continue to do our direct lending, which is the one-to-one investing and being the note holder. But a lot of folks really are starting to prefer the mortgage fund, the aggregated approach to investing in our first trust deeds, our first lien mortgages at very good LTVs with very good returns and very low risk and certainly very non-volatile. So we're going to get into some of the details here. And first, let's start with what's new. So with Marshall Reddick, obviously we talked about the at quarter turn, which was July 1. We had 49 million, but that is not a static number, right? The capital raise always continues. The business model is perpetual. This is an evergreen fund that will not cease to exist or operate. And so now we've got over 250 capital partners. So Those are some really cool milestones, again, starting from zero and doing this in a very organic, Marshall Reddick only capacity. Also, as I shared over email earlier this week, that we've earned and distributed a little bit more than $2 million in earnings in the first 2 quarters of 2023. So just another one of those awesome milestones to hit, and to just see the success and to share the success with those of you who are already partners. Thank you. And for those that are considering becoming partners. Also just happened today, which is so cool, right? We have very few defaults, right? I mean, our private lending program as it is, through 3,000 plus loans now, has a hair more than 50 total defaults. That's under 2%. The number in the mortgage fund is even lower than that, but nonetheless, defaults are a part of the lending business. Now, with this all in mind, understand that this particular property was one that we had to, for a very unique scenario, go all the way through the foreclosure process. And at the culmination of the foreclosure process, depending on the state, in this case, this is Oklahoma, which is a judicial foreclosure state, so it ends in what's called a sheriff's sale. So we were out there today, bidding on the property as the lender, and we were almost certain that we were going to take that property. And in, what just goes to show what good solid underwriting will do and lending against good collateral assets, this property sold for a sufficient amount for us to get repaid. And so I just love that as an example that it happened today. Funny things happen, and that we're going to, be able to recapture that capital, right, without loss, and to be able just to redeploy. So it's important to understand that just because we have defaults, as long as we've done our job from an underwriting perspective, then we should have no risk of loss of principal. That just means we have to do something. We have to get a lawyer involved. We have to file the paperwork. We have to follow through on it. And as property managers and real estate brokers and investors, different than a bank, we're more tooled to be able to handle these types of situations as they periodically arrive. So kudos to the fund and to the team, and really happy to have that happen today. Lastly, in terms of with what's new, our investment management software, that's AppFolio, right? Many folks are probably familiar with AppFolio PM. Well, they also have an AppFolio IM. They just launched an app recently. So if you're into tech and you like to use, and you're operating on your cell phone a lot of times, go ahead and download the app, right? It works really well, and it's the same portal that you've been used to logging into to manage your investment and see your contributions, distributions, and so on. All right, let's dive into some of those details, right? And we'll move through this pretty quickly. So as we mentioned, MRMF is a debt fund. The only thing we do is lend money, first lien only, non-owner occupied only. How do we make money? Well, we do it like any lender does, right? We charge loan fees, commonly referred to as points, and we also charge interest on each loan that we make, right? We strive to earn 2 to 3 points on every loan and earn interest rates depending on loan to value and term and other metrics of the loan between 6 and 12%, right? So those loan fees, however, those points, those are one of the main things that drive our yield, and one of the reasons that we really enjoy short-term debt. Because if we have 6 to 12 month loans and we're getting that capital back at the end of those terms or before, we're able to turn that capital, earn another 2 to 3 points, and that really helps us drive this yield, as well as maintain liquidity for our fund capital partners who at some point in time need to get their capital out. But in all reality, we have had very, very few redemptions, and I really chalk that up to people's they love the constant cash flow, right? And that's something that when you're investing and considering investing in this fund, it is a pure cash flow play.
Yeah, and if I might add real quick, Patrick, we said that this really truly is passive. As someone who owns real estate and has assets and property managers and other streams of quote unquote passive income, we wrote a check to the mortgage fund and I check my portal quarterly, and that's about it. And we reinvest, and this truly is a passive way. And each quarter I just look at that account increase, and it's really remarkable to see you make an investment and then literally do nothing. So it's quite incredible. It's really nice.
Yeah, thank you. As far as the target return, that number hasn't changed. Our business model is all about that 8% annual return, and just to kind of quantify that, that's a net to capital partner. So from a gross perspective on the capital, we need to earn about 12.5% to be able to hit that number. Our returns are distributed quarterly, so the 8% would be a 2% per quarter, where the 12.5 would be a 3.125% per quarter. We're certainly going to look at that later when we break down what the returns were for the second quarter. And a lot of folks have asked about that yield. And yes, I do think that now that we've had rising interest rates and higher government rates for an extended period of time, the longer we have those, then the more time there is for the private lender capital to be eaten all up, for that supply to have dwindled. And we haven't been able to raise our interest rates as fast as we would like. And the reason for that is because there is so much private capital out there in the world, and there's so much competition. So really good borrowers, right, that are sophisticated, that have a good track record, they have tons of options. And those are the folks that we want to lend to. We don't want to lend to the weekend warrior, right, this is their first flip and they think they know how to do this. Those folks, certainly, could I charge them 16, 18%? Yeah, but how many more defaults would I have? And would that be better or worse for the overall yield? So again, from the fund manager's perspective and from Marshall Reddick's loan committee perspective, understand that this is all about safety and about ensuring that there is quarterly income that you can count on. As far as the actual return, that breaks down into two elements, right? There is a preferred return, which is a hurdle that we must get to before Marshall Reddick, as the general partner, can participate in any profits. So 6% per annum, 1.5% per quarter, and any profits above and beyond that will be split 50-50 with the manager. Now, it's also important, there's no hiding that there is a management fee, right? This is standard for small private placements like ours, but note that this is not a load fee, right? So if you invest 100,000, you get credit for 100,000. It's not like you give me 100 and I credit you 98, right? That's not what this is. So the management fee is an expense to the fund, and so that 2% is already accounted for when we look at that 8% per annum. Right, it's part of the difference between the 12.5 and the 8. Okay, as of July 1, as probably a lot of you have seen, because you're familiar with our due diligence page, we had 246 capital partners and roughly 49 million in capital on hand, 210 collateral properties, and my favorite metric, the 62.5% loan to value. Now, the number of capital partners and the capital does not change in a real-time basis on that due diligence website. But of course, capital doesn't stay static, right? So as I mentioned before, we're over 50 million, really excited about that. We're over 250 capital partners, and obviously you know our minimum at 25,000, but to quantify the range, my top investor has a total of $5 million invested. So I have the range all in between there, and as I said, folks contributing regularly or withdrawing as needed. As far as our staff, and I love this too, the staff truly believes in what we're doing here, and this doesn't just go for the fund too, right? Our staff also does the direct lending. They also buy rental property. They use Marshall Reddick for property management. It's part of the educational platform that we provide, and it's not mandatory, but it's as close to mandatory as possible. You've got to be able to, if you want to sell what we do, you've got to do what we do. And so I love to be able to share that 5 million of our 50 million is from our in-house Kristen, myself, and the other Marshall Reddick staff. So that's 26 out of our roughly 250 capital partners today. As far as the LTV, as I mentioned, of course, LTV stands for loan to value, and this equals safety, right? The lower the loan to value, the safer you are as the lender. So it also means that, and I love quantifying this, the capital on hand, the investor capital, is secured by now probably north of $80 million worth of cumulative value across the 210 collateral properties. Now, the portfolio of the collateral properties, it changes every day too, right? We get payoffs every day, and of course, then that collateral property number goes down. Or as soon as we get that capital, we originate new loans. It's all about the velocity of money. But just note that that LTV always moves, and it's in real time on that due diligence page. And so again, it hasn't been over 65% since inception, and it won't go over that number. So this literally means that the market could drop nearly 40%, and we still wouldn't be in an upside down position. So again, this metric, I sleep fantastically well at night, and you should too. As far as the last metric here, the portfolio is heavily weighted towards single family homes, and that's by design as well. Okay, single family homes are the most easily valued in terms of current market value, after renovation value, and so on. And also they're the most easily tradable, right? So in the event we're forced into a default situation where we have to take action, potentially foreclose, right? The market for single family home buyers is enormous. It's the most of any real estate class. When you start getting to duplex, fourplex, 10 units, 100 units, or commercial properties, the pool of buyers is so much smaller, and they're all professionals, where the pool of single family home buyers are your local white collar, blue collar, doctors, lawyers, teachers, you name it, right? So again, I love the fact that we're heavily weighted as high as 80% in terms of the collateral properties in the portfolio. So again, just to kind of sum it all up, the mortgage fund is a secure 100% passive way to a pure cash flow scenario. We showed this for the first time in last quarter, and we're showing it again here. This simply is just a graph to talk about the new incoming capital by quarter and since inception. And I just love seeing this, right? Because it's very stable. It's just how we designed it, right? It doesn't do any good to take 50 million overnight and then have it sitting on the sidelines. That would produce cash drag and drop the yield. We don't want that, right? So we're constantly just watching how much capital we're taking in and making sure that we can keep it working. As far as the earnings distribution, also very cool to show. So what's happening here is the entire bar graph represents what the quarterly distribution was from a before split with the investor, right? So the orange is the amount then going to the investor, and the purple is Marshall Reddick as the manager. That's their profit split. So again, at the bottom, you can kind of quantify that. The earnings, that represents the entire bar. The partners, that represents the orange. That's what the capital partners are getting. And then as far as management's share of the profit, that's the bottom, and that's the purple, right? So again, extremely consistent just by design. Now, some folks also point out and say, hey, the yield dipped a little bit in this most recent quarter. Is there anything to be concerned about? And the answer to that is absolutely not. There are so many moving parts in what we're doing. And when I think about and quantify over the last month since the end of the quarter, what has been a contributing factor to that, and it's very simple, right? There was 6 to 7 loans that we had on deck that we anticipated to close before June 30th, and for reasons that we couldn't control, those loan origination dates got pushed out, and that revenue is then recognized in the third quarter, right? So that 6 to 7 loans in terms of origination represents north of $50,000, and that 0.04% on the 1.96 to 2.0% represents much less than 50,000. So absolutely nothing to be concerned about. We're right on target. Portfolio metrics remain extremely strong, low defaults, timely interest payments from all of our borrowers, and I just have to chalk it up to extremely solid underwriting, really good loan guidelines, right? And really, really good collateral assets that we're lending against. Okay, as far as the website goes, this is the due diligence page I've been talking about. So I'm going to jump over and we're going to dive into that actually. So Kristen's showing us here, we're at the Marshall Reddick homepage. You hover over invest and click investment fund. And this is where you come to and you kind of understand, what's going on. This website is suited for both current and existing partners. Let's pause right there for a second. Fund information, right? So for those particular folks who are considering investing in this, the structure, purpose, strategy, and documents, this is the technical reading, right? So this is the business plan. If you click on documents for me, and this would be actually where you could find like the prospectus. We're not a publicly traded company by any means, but that's the super detailed information. The subscription agreement is the document we would sign to formalize the investment, and the accredited investor letter, that's one way that you can get yourself through the accreditation by having a CPA or an attorney or a financial advisor sign that letter and vouch for you.
So you can explore mortgages in the fund as well. I personally love this map. And I love it because it really shows the diversification that the fund has, where our investments are. You can see that we're across the nation in landlord-friendly states. Our borrowers are improving non-owner occupied properties only. It's the only type of asset we lend against. And what's really cool to me especially is that in the other states where Marshall Reddick has our own brick and mortar real estate offices, Texas, Tennessee, Florida, 36, 18, and 41 current loans as we speak in those states. So really cool to see that the fund is across the nation, servicing all of these, borrowers. And I think probably 3 or 4 of those 41 Florida loans might belong to me and my husband. So just really cool to see this quantified. You hear millions of dollars and 210 properties and, so many numbers. And I really like this map to help kind of put that into context. You can really see where, what our footprint looks like in terms of the fund.
Yeah, and if you don't mind also, if you want to click on that 41, this is cool too, right? So people can get really granular with what the portfolio looks like in real time. So you can come to any state, you can see like what are the actual loans that we have securing the capital, right? And then you can even dive into those. We won't do that now, but if you were to click on any of those, it takes you to a detail page that tells you what the loan amount is and what's the interest rate and what's the LTV, and you can look at the appraisal if you want to. It's like, it's all there. And I know a little bit about investing. I've learned a little bit about investing, and I'm just not sure that there's another investment platform out there that's giving you the details if you so desire to explore them. Great. So if you want to X out of that, let's go real quick back to the website, if you don't mind, or did you close it?
No.
Yep. Okay. Yeah. So let's close that there. Let's continue down. So something else I really like to have, if you go down just a little bit more, is that historical performance. Oh, first and foremost, the investor letter. We always, at the end of every quarter, we're going to post the investor letter here. You can always download it, and it includes the financials. Again, just following along with our, hey, this is what we do. This is the health of the fund. If you like what we do, great. We'd love to have you join us. And it's not for everybody, but we like what we do, and we think you probably do too.
And that sorry, Patrick, that Q2 investor letter is one of the handouts that's attached here tonight for those of you who are looking into the fund, are interested, are checking it out tonight and do not have a capital position yet. Check out that investor letter. That's something you'll receive quarterly once you do become a partner in the fund. And this is going to announce the quarterly earnings. This goes out the Friday of the 3rd full week following quarter end. So we get these out in a really timely fashion so that all of our investors can see the performance and get an update on our earnings for that quarter.
Yeah, so just 2 more things and we'll jump back onto the presentation. But right here you can still see too the quarterly distributions history. So we're just going to continue to publish that on into forever, and the general trend is on an upward trajectory. And then lastly, 2 things. Obviously, there's that Invest Now button. That's step 1. If anybody is, ready to go and wants to, speak to a fund consultant like Kristen or get, take the next steps in terms of accreditation. And then lastly is going to be, I think right below this, there's a calculator. tiny bit above this. Yeah, right there. So you can play with this. It just defaults to an initial investment of 100,000. That's a common number. Just with the 2% quarterly distribution, that's our target. No additional contributions, and reinvesting the distributions take a part of compounding. And you can see over a 5-year period, you're earning 48,000 and change. Right, so change that number, mess with it, however you'd like to understand what the returns could do for you. Is certainly, 2% per quarter, it's 2%, right? And might to some people sound low, but if you talk to real investors, right, those that really have capital and really value safety, they're going to be like, man, if I can get 2% a quarter for the rest of my life, I'd be in really good shape. So awesome. Let's we'll drop that and jump back to the presentation and move on. So yeah, we went through this, so we won't spend any time, but these are the items that we just went through. And then the fund portal, right? We spoke about how they have an app now. So download that if you'd like. This is what the login screen looks like. And again, this is where you track your contributions, your distributions. This is where we publish the earnings. This is where you download your tax forms. Your K1s are there. Our wire instructions are there. I mean, it's all there. This is a quick screen clip of what it looks like. This is inside mine for the year 2022 and just quantifies like what my personal investment distributions looked like in last quarter. Okay, what other information is there that I didn't just speak about? One thing that's cool is linking a bank account, right? And so this has become really important for those taking distributions, right? As you can safely and securely using the Plaid, that's another third-party software company that's integrated with AppFolio to safely and securely provide your banking information so that we can direct deposit your returns to you. But it's also been useful for those people who want to build their exposure and have like a monthly or a quarterly or an annual drip of dollars, investment dollars into the fund. We can utilize that account with your authorization to directly pull those funds from your account of choice. I mentioned the tax forms. I didn't mention, which is very cool, is to upload documentation to us. And a lot of times that information revolves around accreditation. So it could be W-2s, could be tax forms, could be other information that maybe you're concerned about. That's the safest and securest way to upload that information to us. And of course, you get to see the transaction history, you get to see your statements and so on. So it's really, it's a helpful thing. Besides, of course, changing your election from taking to reinvesting, or to add more dollars or change your mailing address, it's all there.
All right, so how do you get to the portal? I'm going to jump back to the website real quick because this is going to be an easy visual. When you click login on the Marshall Reddick website, you get a choice. Investment fund portal, you click right there and it's going to take you right to the page you just saw on our presentation. This would be my investor portal login. So there's my email, here's my password. That's how you get to that from our website if you're logging in directly. You're going to see this. Click on that. You can also get there from the due diligence page that we looked at on the website. You'll see a big button, Invest Now, or you can log in here right under that big Invest Now. So there's a couple different ways to get into your own portal to manage, as Patrick was just speaking about, manage your capital investment, add more, change your selection, whatever the case may be. So there's multiple ways to get back into your portal to keep track.
Yeah.
Or you can download the app. Some of us out there are very technical. We like to do work on our phone, and at the click of a button, you can look at your portal, you can change your options, you can monitor to your heart's content.
Yeah, very good. It's surprising how many folks, and my father being one of those who has a position in our fund, and he can never remember where that website is. I'm like, it's right there, just click log in. Anyways, let's get to some of the meat and potatoes here. So as far as the rundown, we're going to talk about just briefly the fact that we do have periodically problematic loans and defaults, right? But the good news is that it's few and far between. And remember, a default doesn't mean loss of principal. Okay, and that's just quantified by the share of sales scenario I told you in the Oklahoma transaction. So we've literally had like a total of 4 problematic loans in the fund after like hundreds. I think we're getting close to 600 loans originated now. And so we had no new problematic loans or defaults that materialized in Q2, and we don't have any on the horizon. So the portfolio remains extremely strong. Now, we're going to jump back to the website. I'd love to. And the fact there, I do have the links. So we're going to be sending out let's jump back to the presentation. We'll come to the website. But when we send out the recording, we'll send the PowerPoint. And you should be able to link right there from these URLs that we've provided. So if we can jump forward, yep, here. Okay, so like you're curious, right? You want to track what defaults are there or happen, or if there's any. So as far as those that maybe have delinquent payments or potentially problematic loans, and I've got the sub bullet point there being like actually how you would navigate from the mortgage website, which you would just go to mortgages, payment status, select late, delinquent, in default, plus the mortgage owner MRMF. But I've conveniently provided you the link. So I think if you click right there, Kristen, on yep, and this takes you right to our mortgage website and would show you the 4 loans, right, that were potentially problematic. One of those being 27th, which as I mentioned, sold today. I completely shocked for how high it sold. And so that now is going to be off the books. And then again, a handful of others.
And I really like that we do this. You know, part of Marshall Reddick's platform and business model is transparency. We want our investors and our clients always to know what's going on, always to have all the information, and we want to be really transparent and really clear on any risk and the reward with all of the investments that we offer. So this, of course, is also not stagnant if there are additional defaults, or this one, as we mentioned, 27th is going to be off the books. So if ever you are concerned and you want to check that out, you can, and all of that detail is going to be right there for you. Great. Transparent.
Yeah. Perfect. So I'm going to jump back to the presentation there. And then the other link, again, this would those to take you to those that were completed in a default status. So if you want to go ahead and click on that, that gives you a slightly different subset. It does include the 2 of the 4 that we just saw. And one I'll comment on here, which is not 27th, which is this one on Illinois. And this is also a great example, right? So this one ended in a status that is settlement with profit. And what does that mean? That means that we were able to get the asset sold at a sufficient amount to A, repay 100% of the principal amount of the loan and some interest. We didn't get all the interest in this case, right? But there was no loss of principal and still profit. So still very beneficial to the fund. And these are the types of defaults that we experience. Again, chalked up to good underwriting and valuable underlying collateral assets. Okay, I think you already mentioned the handout. The one we were trying to go to here was the investor letter.
Yes, this is your investor letter. That's going to be quarterly. So the one we have attached is the Q2 investor update. Quarterly, this goes out to all of our investors with the capital position in the fund as a update to announce our earnings. And of course, you can also check your portal for the quarterly earnings updates as well.
Okay, I love this part of the update, right? Because so many people, it's very simple, but so many people have kind of a difficult time like understanding and breaking down the returns and how the quote waterfall works. And all that means is like we take all the income at the end of the quarter and we waterfall it down the list of investors by their percentage of ownership. And if you came in mid-quarter, right, you only obviously earn a per diem or a prorated based on the number of days you were in that quarter, but you have to have some assumptions here in order to calculate this. And the reason for that is that simply the capital is not static at start of quarter and end of quarter, right? There's literally people coming in every single day, and periodically there's people leaving the fund. So the capital stack is moving. But the easiest way to get very close, and the assumption we'll use here, is taking the starting capital at Q2 start and the ending capital, right? Take the difference between the two and split it in half. So for this calculation and to kind of quantify, the easiest way possible is that we're going to assume that there's static capital of 47 million and change, as shown in that sub bullet point there, using an even split for this calculation. Great, and so what we're going to do is we're going to break this down by percentage and then also by dollar amount. Now notice my footnote there, right? These percentages are actual, right? So again, if you try to do the math, you're going to be a few hundredths off, but the visual gives you really how the breakdown works. So if you were to take the investor letter and you were to match it with the profit and loss statement that was a part of that letter, that's what these numbers come out to, right? So our gross income represents 2.94% of all the capital as it came in or left every single day in the quarter. The expense is the same, right? And of course, the expenses include that management fee that we talked about. It's there. Remember, 2% a year, so 0.5% a quarter. So our income, our net income on the P&L works out to 2.369%. Now, hypothetically, as I've shown you there, if I just multiply these numbers times 4, this would give you the per annum perspective, right? So again, our gross income would be at from a percentage standpoint represent a little under 12%. Our net would get you down there. Third-party expenses, of course, would be just like loan servicing, CPA, attorney fees, and so on. So to break down like what happened in Q2, same as on the investor letter, let's take the next step. So we had income, again, net at 2.369%, right? Supplementing there with a little bit of our loss reserve. And then, of course, we add those two numbers. Then if we have to pay out the preferred return, that's our hurdle. So if I take 2.369% plus 0.015% minus my 1.5% preferred return, I get to a profit that's to be split. Again, 50-50 with Marshall Reddick. 0.92 divided by 2 gets you your 0.46. And then, of course, I'm simply taking my preferred return at 1.5 and my 0.46 to split. The investor return in this scenario is the 1.96. So just breaking it down very, very simply. Okay, then here, I'm not going to run through the exact scenario because this is exactly the same waterfall that I just provided, just instead of doing so with a percentage standpoint, I'm doing so with like actual numbers from the P&L. So I hope that that's helpful. And again, remember, these are actual in lieu of our static capital assumption at that $47 million number. I want to pause for a second. I'll finish this slide and then I'm going to address a question from the crowd. So breaking down this a little bit further, right? For those that, let's say you've got 100,000 to invest, right? In this quarter, if you had 100,000 static, meaning it was there when we started the quarter, it was there when we ended the quarter, your preferred return would be the 1,500, your profit share would be the 460, so your total return would be the 1,960, which equates to a quarterly return of the 196. And then therefore, hypothetically, if we did the exact same thing, that would be your expectation based on this last quarter. Now, I'm going to pause for a second because I have a capital partner, right, that is suggesting his thing is that, hey, you got a great return. I like that. But I'm currently considering investing in a, he says, quote, risk-free money market account. Okay, that is ranging at 5%. First off, please tell me which bank that is because I haven't seen 5%. But nonetheless, the idea still exists because banks are struggling for deposits right now, especially the littler banks, the regional banks, right? The big banks, no problem, right? Now, but given the volatility, given what happened to Silicon Valley Bank, given what happened to First Republic and so on, if you think that your funds sitting in a bank are risk-free, and if you think that the FDIC insurance has enough money to cover you in the event of major catastrophic meltdown, I'm sorry, I don't believe that. And I asked my wife the other day, I said, hey, can you really imagine, or you thought, she's a little bit younger than I am, 7 years younger, like, could you consider like your money in the bank could ever be at risk? And of course she said no, right? And I think even further, like millennial or Gen X or like whatever they are, Gen Z, like you just don't even think about that, right? But I'm telling you that you can lose money in a bank too. So those, and the higher those yields get, to me, that indicates that they are struggling to raise capital, right? And they need liquidity. That's why they're willing to offer you that number. And so that scares me a little bit. Whereas you come to what we're doing, right? Certainly everyone would like a little bump in the yield, right? But at the end of the day, I'll take lower yield for safety any day of the week. And that's how I approach the luxury and the ability to have you guys trust in me and in Marshall Reddick to manage your capital. So we're going to get towards the end here. Now's a great time to invest in the mortgage fund. As we've talked about, right, it's designed to produce the low risk, consistent stream. And as you know, it can be counted on every quarter. We haven't had but a blip in our income, our expense, or our net profit that we're continuing to share with the partners, right? And all backed by the safety of first lien debt, right? Which is what you don't get in the money market account, right? Certainly banks are safe. I'm not saying that they're not in the grand scheme of things, right? But the Fed is going to let some bank fail soon. They've done it in the past, and just because they bailed out a couple here recently doesn't mean that they're going to continue to do that, right? With us, worst case scenario, right? I got a whole bunch of valuable collateral assets that we're all going to own, and all of our principal is very safe. Okay, this offers a non-volatile alternative to the stock market, and I can't tell you how many people, maybe not in the last few months, but over 2022, that said, man, I'm really glad I had my money with you and not with my stocks and regular stuff, because I was getting hammered. And as Kristen mentioned earlier, right, this is perfect for a self-directed retirement, especially because there is no UBTI.
It's a great means of diversification too, for those of you joining us tonight who maybe are real estate investors and you own assets up until this point, you're looking for a means of diversification that's still real estate related. This is another reason why I really love the fund as well, is because it's a safe way to park some of our cash that we're not currently investing in a piece of property to help accumulate more, get that return that we can expect on a quarterly basis, and not do anything. So it's really a great way to diversify within real estate without increasing your asset count.
So as a part of the kind of economic volatility that we've had, and I spoke a little bit about this in addressing that last question, the credit contraction continues, right? So banks, especially the regional or smaller banks, they're just not lending, right? They're trying to shore up their balance sheets. They're trying to grab onto cash because they're trying to avoid a run on the bank. And, you know, although the overall market has settled a little bit, I think a lot of that settling came because, you know, they had a pause in the interest rates. I do realize they just raised again, but there was a pause. And that was about the same time that Congress got their act together and settled the debt ceiling issue. So I think everyone kind of took a cumulative sigh of relief, and I think we've gotten back to normal. But the banks have not forgotten, and they know how unsure they are with a lot of debt on their books that may be risky, right? So because of that, and they're not lending, I'm telling y'all that the demand for private capital for the foreseeable future is going to be very high. And this is producing an awesome dynamic and a lot of opportunity for us here and for all private debt funds, right? So the bottom line is that we've got more demand for capital and really good assets than we have capital on hand. Now, as far as the Q&A goes, we're going to run through a couple that are normally going to be, you know, asked and go from there.
Yep, we're going to start with some of our FAQ, and then, as we mentioned, there's some other questions maybe in the chat that we don't have time to get to tonight live. You'll definitely be getting a phone call and a follow-up from your fund consultant or myself to make sure that you get all that info and detail that you need. So frequently asked questions, I'm not going to read all of these, but we're going to go ahead and jump to the answers.
Before we jump into these kind of standard ones, I do have another good question from the crowd that I'd like to answer. And it addresses, is Marshall Reddick Mortgage Fund on the path to installing the REIT structure? REIT standing for, of course, Real Estate Investment Trust. And the answer to that question is 1000%. Right? Big investors, and the general trend for funds like ours is to make that REIT conversion. Okay, and so what does that actually mean? Well, in the short run, the REIT installation costs money, right? So we haven't made the move yet because we're very conscious of our yield, right? And we're talking about between attorney and accounting and tax advice, we're talking about $150,000 in expense to the fund to make that conversion. Right, so we're going to do that strategically when we have enough assets under management. So about 50 million now. Sometime I think between the around 65 million is going to be the right time to do that. So I'm thinking about 12 months from now we'll be making that conversion. Now, what does that do for the investors? Well, it's a humongous bonus, right? Because what it does is, at least under current legislation, is that there's a 20% qualified business tax deduction that will be passed through by the REIT to the investors. Now, I think that there is an existence of that now, but it's blocked for investors in a partnership like ours that are over a certain amount of AGI on their tax return. Right, so a lot of our folks are high income earners or have a lot of investment income, and so they lose that 20% QBI tax deduction. With the REIT, the pass-through applies to any investor and doesn't apply to considering what their dollar amount is that they're earning. And so right out of the gates, your returns become 20% less taxable. That is huge, right? Think about my guy that's got 5 million invested, or my dozen or so people that have $1 million invested, right? That becomes now, I'm not just worried about collecting 8%, I'm worried about saving on income tax, right? Some of the other things that it will do for us, there's some other tax benefits, but number one is that it will allow us to bring on leverage so we can get a credit line for the fund without subjecting our IRA or solo 401k investors to UBTI, right? Because the REIT will block that. So there's a number of reasons to make this conversion. We are absolutely going to do it. We already qualify in terms of how we operate. It's just a function of the timing. So if you have more individual questions about the REIT conversion or really anything, Kristen's available, I'm available, we'd love to speak to you. But besides that, we're going to move through these frequently asked questions and we'll get ourselves wrapped up.
Yes, we will. So an accredited investor means you fit one of these qualifications. Your income is 200K per annum, 300K including your spouse, or your net worth is $1 million plus. Investopedia is a great third-party website that you can use to show us that you are accredited. You can also upload your pay stubs. You can upload a series of different documents to show us that you can that you are accredited. And this is not an MR requirement. I get this question a lot. This is a government requirement to invest in the fund. This is not something that Marshall Reddick implemented on our own. If you have more questions, please call me. What are the steps to invest? So you book a consultation. On the website, you can click Invest Now. That'll notify us that you're interested, and a fund consultant will give you a call. You can also scan the QR code here. You get accredited. So this is the slide we were just talking about, showing us that you fit that qualification and that you are an accredited investor to be part of the fund. You'll set up your online portal on our website, as we walked through a little bit earlier. You'll sign the subscription agreement and the other documentation there in the portal that gets you set up. And then you finally will set up your account. If you would like your distributions quarterly, you can also attach that to continue to make contributions, or you can set your account up to reinvest quarterly and keep your funds growing. All right, if the residential real estate market softens, how will MRMF be affected? We don't expect to be. As we talked about, we have good underwriting, we have strong LTVs, valuable overall collateral assets, and our borrower base is vetted very strongly. So as Patrick mentioned earlier, we're not just charging absorbent interest rates and loaning to any, geek off the street, as they say. Our borrowers are vetted, the collateral is vetted, and they're underwritten very well so that we don't expect to be affected in any way. Real estate remains resilient. I hear the word crash thrown around and I hear correction, and I don't like these words because overall, if you look at a graph, real estate remains strong and it's a good investment and it trends upward regardless of how far back you look. The yield could be affected in the event of a correction, but the portfolio diversification is such that we, again, don't expect for the mortgage fund to be affected in the event of a softening of the real estate market.
I absolutely wholeheartedly believe that. I think that's predicated by some of the defaults that I shared, and going back to the sheriff sale that happened today. And that's also one of the reasons that we just have like no problems with late payments, right? We just have too good of collateral assets. That borrower base is one thing that isn't quantified generally by a lot of investors because they don't know the relationships with these folks that I built over the years, I should say. And it's like these people borrow from me on a regular basis to support their professional business, right? And flipping homes and building homes, it's hard. And so they lose money sometimes. But what they do value is the relationship with Marshall Reddick, and they want to continue to borrow from Marshall Reddick. If they default, we obviously have a zero tolerance policy and we cannot lend to them again. Couple that up with obviously an extremely solid residential real estate market, a lot of problems in the commercial market, a lot of people don't want to go back to work, right? So office is struggling, other sectors, but residential real estate is just something, barring just absolute meltdown, is just going to remain super solid. And come on, let's all be honest. If we had this correction or this meltdown, as some conspiracy theorists might say, we're all going to be in big trouble. But remember, what you get with the mortgage fund is actual, real, solid collateral, not fake, not on paper, real assets, right? So just the idea of loss of principal is just so unlikely that, again, you should feel really good about investing. I certainly do, and I certainly keep building my exposure to the fund as I grow my capital.
All right, what's ahead for the Marshall Reddick Mortgage Fund?
Yeah, so as I mentioned, a couple of these things, so we'll just kind of jump through this. The demand for non-traditional private capital is high. I expect that to continue. I expect it to increase. We're going to continue to gradually raise the capital, right? But in a slow and safe manner, right? The earnings and the profits and the quality distributions, I just absolutely expect to write you a check every quarter, right? At 2% or better. Right. We've had some folks ask about the yield, right? Certainly now that interest rates have stayed higher longer, and probably we're going to see 5, 6, 7% from government for the foreseeable future. Now I can start raising my rates and my fees. And so we've already gradually done that, but we're doing it very gradually because we want to retain that good talent, that good borrower talent that has kept us in good straits for all of these years. And then I mentioned the benefits. I kind of jumped the gun and went to the REIT because we had some folks ask about that. But we also have a follow-up question there about the liquidity and changing to a REIT. And so the answer to that is no, right? Installing the REIT structure has no impact on liquidity. And our liquidity is fantastic. Predicated mainly by the fact that we're so heavily invested in short-term debt, which also reduces our risk in terms of interest rate risk, right? We're not making 30-year fixed loans. And so, if the rates rise tremendously in our short-term debt, we're getting paid off in 6 to 10 months, right? So then we can reprice our loans. We can charge higher fees. We can do whatever the market will bear. So by installing the REIT, there's no change in liquidity, right? And we just, to speak to the redemptions, right? The paperwork calls for 90 days, but we're able to do it generally much faster than that. Depending on your need, right? And it's beneficial to you as the capital partner to exit at quarter end so that you get the full earnings of the quarter in which you're attempting to redeem. I think the last question we have, and we always get this, is what's the loan loss reserve? This is simply a small allowance of earnings that's set aside to cover loan losses. And loan losses such as sometimes you have to renegotiate or modify a loan. Sometimes you have a loan goes non-performing, right? We're not collecting payments for some period of time. Just because we're not collecting them now doesn't mean we're not getting the money, just as predicated in the short sale or the, sheriff sale that happened. But the idea is that our operating documents will allow us to hold 1 to 6% of NAUM. Typical for our fund is 2%. We're currently holding a lot less than that at under 1%. So this is not currently reflected on our profit and loss. But I think we're likely to change that in 24, right? Because this is used to accurately reflect the overall financial health and to stabilize distributions. So I love those questions. I really appreciate the crowd participating, and Kristen, you're awesome. Thanks for being here.
Thank you so much, Pat. Thanks for having me. And thank you all again for joining us. Really hope that everyone learned something tonight. Hopefully you heard what you wanted to hear. And with any additional questions you have or to get started, please don't hesitate to reach out. We'd love to help you get pointed in the right direction.
Bye now.
Bye-bye.